Hello everyone and welcome to this new video about moving averages. We're going to explore this powerful indicator, and by the end of the video, you'll have a solid understanding of how it works and how to use it in your trading journey. So, here's the table of contents. Let's start with the different types of moving averages you need to know and why they matter. Alright, a simple moving average, or SMA, is a line on a chart that shows the average price of an asset over a certain number of past periods. For example, this orange line is a 50 SMA. Each time a new price appears on the chart, it replaces the oldest one in the calculation. You should know that the most commonly used price is the closing price of the candle. So, here's the formula used to calculate the SMA. As you can see, it's simply an average of n data points. To make it clear, here we have the 20 SMA, and the last point of this line corresponds to this formula. The 20 data points used in the calculation are shown in the orange area. But watch what happens when a new candle appears. The oldest data point is replaced by the newest one, and the formula is updated. This process is repeated with each new candle. The last value is always based on the latest available data. This means the 20 data points used in the SMA calculation shift forward over time to reflect the most recent information. So, as you can see, the orange area moves dynamically. So, if we go to TradingView and want to display a simple moving average, you just go to the Indicators tab, type in SMA, and click right here. By default, you'll see a 9-period simple moving average added to your chart. But if you click on it, you can modify the settings. For example, you can change the length, which is the period, and you can also change the source. By default, the source is the candle's close, but you can switch it to the open, the high, the low, or even take an average of those values. Okay, let's plot the 50-period moving average. You'll notice that the line is less reactive than the 9-period one, because it's based on the last 50 closing prices instead of just 9. Let's now talk about the exponential moving average, or EMA. Unlike the SMA, it gives more weight to recent prices, making it more responsive to new data. Here's the formula used to calculate the EMA. As you can see, PT, which is the most recent price, is multiplied by a weighting factor called alpha. This alpha is equal to 2 divided by n plus 1, where n is the period. So, alpha determines how much importance is given to the latest data compared to the older ones. Let's go back to TradingView and plot the exponential moving average. We'll change the settings to display the 50 EMA and, of course, adjust the color. So here, in orange, we have the 50 EMA, and in blue, we have the 50 SMA. You can see that the two lines aren't exactly the same. The EMA reacts more quickly to recent price changes, because the most recent data has more weight in its calculation. There's also something called a weighted moving average, like the front-weighted MA, which gives more importance to recent prices, just like the EMA. But here the weights decrease in an arithmetic progression. This is the formula for the FWMA. It might look a bit complicated at first, but let's take a simple example. For a 3-period moving average, the formula looks like this. It means the most recent price has a weight of 3, the previous one a weight of 2, and the one before that a weight of 1. Then we divide the total by the sum of the weights. It's much easier to understand the formula this way. We have the same concept with the back-weighted moving average, but in this case, more importance is given to older prices. The weights increase in arithmetic progression as we move further back. Here's the general formula. And for a 3-period BWMA, we simply reverse the weights, giving more importance to the oldest price. Let's plot the weighted moving average. We'll set the period to 50. And you should know that by default, this WMA is a front-weighted moving average. As we can see, this line is more reactive than the SMA, and slightly less reactive than the EMA in the short term, but it tends to become more responsive over time. If you want to plot a back-weighted moving average to give more importance to older data, you need to go into the source code of the WMA. Just click here, and you'll be taken to the script. Inside, you'll find the function used to plot the WMA. Hold Ctrl and click on the function to dive deeper into the code. Here, you'll see the algorithm that calculates the moving average. To switch to a back-weighted version, you just need to reverse the weight factors or modify the loop accordingly. There are many other moving averages out there, but let's focus on the three most important ones. First, there's the triangular moving average, which puts more weight on the data in the center. It's particularly useful for finding cycles. Here's the formula, and as you can see, the middle data points carry the most weight. Then, we have the geometric moving average, which is especially useful on percentage changes or logarithmic scale charts. Here's its formula as well. And finally, there's the adaptive moving average, which adjusts its speed based on market volatility. It reacts faster during strong trends and slows down in sideways markets. All right, now let's see how moving averages can help spot a trend. This indicator is really useful because it acts as a trend indicator. Basically, when the price is above the moving average, the trend is up. When the price is below the MA, the trend is down. And if the moving average is flat, it usually means the trend is sideways. Let's switch over to TradingView and analyze Litecoin, for example. Here, we can spot a flat moving average, and if we look closely, we can see that the price is stuck between this support and this resistance. So we're in a sideways market. Then, the price drops below a declining moving average, and we can clearly see a downtrend. After that, the price goes above the moving average, and the trend turns upward. But right here, after a crossover, the price moves back below the moving average, and the trend shifts down again. It's very useful to spot the trend. Now we're going to see how a moving average can also act as a dynamic support or resistance. In fact, an MA can serve as support in an uptrend and as resistance in a downtrend. These support and resistance levels are dynamic because the moving average moves over time. When it lines up with a recent swing high or low, it becomes a really powerful support or resistance level. As we can see in this picture, the price reacts to the moving average while also hitting a previous resistance level. That combination makes it a strong bearish signal. For example, we can see that the 20 EMA acts as a resistance in this downtrend. In fact, the price fails multiple times to break above the EMA before continuing its move downward. Let's now talk about winning strategies that involve moving averages. The first one is the Golden Cross and Death Cross strategy. It involves combining moving averages of different periods to generate a signal. The Golden Cross happens when a short-term MA crosses above a long-term one. It's a bullish signal. On the other hand, the Death Cross happens when a short-term moving average crosses below a long-term one. That's a bearish signal. For example, here we have a Death Cross, and here a Golden Cross. We use the 50 and 200 SMA to get these signals. But before diving into charts, you need to keep a few key concepts in mind. Moving averages should never be used alone to enter a trade. It's crucial to combine them with price action to increase the probability of success. Like any indicator, moving averages are best used to confirm what price action is already telling you. Let's analyze the Bitcoin price on TradingView. Here, we can see a range, followed by a breakout above the resistance level. The blue line represents the 50 SMA, and the orange one is the 200 SMA. Let's look at what happens next. We get a golden cross. In other words, the short-term moving average crosses above the long-term one, which is a bullish signal. Now, looking at the price action, we can see that a new range forms right here, with a clear support and resistance. The short-term moving average is also sloping upward, which supports the idea of a breakout. At this point, we can consider opening a long position once the price breaks above the recent swing high. We place our stop loss just below the last swing low, and we set our take profit to maintain a risk-reward ratio of 2. Let's see what happens. The price moves sharply upward and hits our take profit. We can also use strategies where the moving average is a support or resistance. For example, the pullback strategy. The setup is simple. It consists of buying after a quick pullback in price, followed by a rebound on a support level, which in this case can be a moving average. Let's move over to TradingView. Here, we're in an uptrend with higher highs and higher lows. We have the 50 SMA and the 20 SMA plotted on the chart. We can see that the price just bounced off the 20 SMA, a classic pullback. Plus, if I use a Fibonacci retracement, we can see that the bounce happened exactly at the 0.38 level, which gives us a double confirmation that the price could move higher. So, we're going to open a long position on the breakout of the previous high of this reversal candle, place our stop loss just below the recent low, and set our take profit right here. As we can see, the price continues to move in the direction of the trend. All right, the last strategy is to use MA as an exit signal. It could be a stop loss or a take profit. So here we have USD yen in a clear range, and the 20 SMA is quite flat, which confirms the lack of trend. Let's apply the range strategy, which follows this setup. As we can see, if I add the ADX indicator, it's showing a value of 14. That confirms we're in a ranging market. Then we spot a beautiful doji candle, which is a classic reversal signal. Based on that, we open a long position right here. We place our stop loss just below the recent low, and for the take profit, we'll aim a bit higher. But the main idea is to exit the trade once the price crosses the 50 SMA, like a trail stop. Let's see what happens. There's a strong move upward, followed by a pullback and a bit of consolidation. At this point, the price hasn't crossed the 50 SMA yet, so we stay in the trade. Then finally, right here, we get a clear cross with the 50 SMA, so we exit the trade at this point. Using the 50 SMA as a trailing stop can be a very effective way to maximize your profits while staying in the trend. Let's now talk about common mistakes to avoid when using moving averages. The first advice is don't overload your chart with too many MAs. Stick to a maximum of 2 or 3. For example, here we have 4 different moving averages, and there are too many crossovers, which makes the signals unclear and makes it harder to make decisions based on the chart. Another mistake is using obscure moving averages like a WMA 19 that no one watches. For instance, if you're looking at a front-weighted moving average with a period of 19, chances are you're the only one watching it, and that defeats the purpose. Instead, focus on the well-known ones like the 20 SMA, 50 SMA, 9 EMA, or 200 SMA. Third, never base your trades on moving averages alone. Always combine them with price action or other tools, just like we've seen throughout this video. And finally, you need to choose the right period. Too short gives noise and too long lags behind the market. In this example, the short-term moving average creates lots of signals, while the long-term one generates very few, and as a result, you could miss several good trades. Okay guys, thanks a lot for joining me in this video. I hope it was helpful. See you soon for the next one.